Hi everyone, and welcome back to another portfolio update. So right now I'm sitting at $123,036, and I made a lot of changes to my portfolio since the last update. But before I get into that, I wanted to show you how to calculate your real total return for your portfolio. So this is something that I just added to my spreadsheet so I can see how much purchasing power I've lost since I started investing. So um, what you want to do is you want to go to the Consumer Price Index provided by Statistics Canada and use a reference period that corresponds to since you started investing. So for me, that is May 2021. So if I put in here May 2021 to August 2023. We don't have the September data yet because obviously September is not over yet, and the CPI hasn't been reported for September. So I'll just hit apply here, and you basically get this chart of the cost of a basket of goods and services over this time period. So we can see in May 2021, it's 141 for all items, and we go all the way to August 2023, it's 158.7. So if I pull the calculator up right here, I'll just show you how you calculate the compound inflation since you started investing. So you just put the number for the current period here, 158.7 minus, I'm going to put here 141, and I get 17.7, and then I divide it by the original number, which is 141, and I get about 12.55% compound inflation since I started investing. So what this means is you have your nominal total return. So relative to my net deposits, I'm up 0.36%. That's your nominal total return. So what you have to do to get your real total return is you have to subtract compound inflation since in the time period you've invested. So for me, that's 12.55%, and you can see my real total return is negative 12.19%. So this reflects your loss in purchasing power since you started investing. So I just wanted to highlight that for most people because most people don't really realize how bad inflation is getting and how much it affects your returns. Because you on paper you could have a 10% return, but if inflation's 20%, you're still 10% in the hole. So it's better than doing nothing, of course. But yeah, that's just something I wanted to highlight and something that you should be very cognizant about as you invest. Is how much you're losing out to inflation. So moving out onto the portfolio update. So I ended up selling my TD stock. The reason why was because I was reading on Blossom. Uh, if you're not comfortable with a stock being down like 40 to 50% and don't know like the internal workings of that company to the point where you would be confident in knowing whether it's going to recover or not, you shouldn't be investing in stocks. Like it's plain and simple like that. You should know the company basically inside and out in order to invest in them. Of course, there's exceptions to that, and honestly, like the TD Bank is a pretty safe bet in my opinion. But what if that one bank out of the six is starting to, just really go downhill? How are you going to be able to react to that and know, is that company actually in a good position? So, um, I get enough exposure to the banks with VDY. Like I think Toronto Dominion Bank is one of the major holdings in VDY. Like I think it makes up, I think it's the second largest holding after um, Royal Bank. So let me just see here. Yeah, Toronto Dominion Bank. It makes up 11.82% of VDY. So honestly, like there's just a lot of redundancy. Like I was just investing in TD, which is already in VDY. So if you take 11.82% of like the 21,000 that I've invested in VDY, toward 22,000 almost now, it's basically what I had invested in TD. So I just sold it off and I'm just continue investing in VDY. Of course, if you invest in an individual stock, you don't have to pay an expense ratio for a company to manage the fund for you. So obviously with VDY, there is a MER for them holding this basket of stocks for you, which is 0.22% per year. Um, which is very low. So that's fine for me. So that was my reason for selling off VDY. I also sold off EIT-UN, the Canoe EIT income fund. And the reason why was because it is a closed-end fund. And for me, I just want to stick to ETFs, to be honest. Like with closed-end funds, and I'll show you here if I go to the EIT-UN, we'll go to the fund's website real quick. So what happens with closed-end funds is they can typically trade below or above their actual value. So with Canoe right now, you can see the net asset value is 1274. And do they have the market price here? Oh, I guess the price is literally right at NAV right now, 1274. Okay, so like right now, it's on par. Like the price is actually equal to the NAV, but the net asset value, what the fund is actually worth. But there can be a disconnect with these. So if the price is greater than the net asset value, you're paying a premium for that basket of stocks inside of the fund. So and whenever you buy a closed-end fund, you have to be aware of this. You have to know, am I buying at a premium or a discount, or right now, right at parity? Like, that it's very important to know. And if you're a dollar cost average investor like me, like you just have auto buy set up in Wealthsimple, to me that like you shouldn't be doing that with closed-end funds. You could do it with ETFs because you know that ETFs trade right at the market price is the NAV. Basically, there's the small discrepancy, but like it will just catch up to the following day. It's very, very close. Both closed-end funds, that gap can change with time. So I just stayed away from it honestly. So yeah, all I have is ETFs now. So I have my VFE, VDY, VIU, and VEE, which are basically the components of VEQT. Um, VIU and VE actually being in VEQT, VDY is like there's a slight difference there. I think it's like VCE is within VEQ. It's very similar fund, just getting exposure to Canadian equities, and then VFE is very similar to the US fund inside VEQT. So I'm able to take advantage of particular opportunities and in those components, and I'm also able to save a bit on fees because if you look at VFE, for example, the MER is 0.09, whereas for VEQT, the overall fund, it's 0.24. So I'm able to save a bit on fees with investing in VFE as because you can see it's like a very large portion of my portfolio VFE. So by investing in VFE, I get to save like almost point 10% MER. It's not a lot, but it's something. And I'm also able to buy when things are down and able to take opportunities like when I see things are down more than others. So if VFE is just like a rocket ship and it's flying like above 110, I have the choice to, okay, well, maybe I want to take advantage of VDY right now because it's down big time. And you can see with VDY, it's below $40. It's a great opportunity. So, and actually VFE has been taking a bit of a beating too. So I've been buying it regardless anyways. So, but yeah, like that's my kind of rationale. With the FHSA, I just went all in VQT because I don't want to even think about it. It's just, it's such a small contribution space that you get. It's 40,000 after um, 5 years. So it's not a big deal, honestly. So I just went all in VQT there. And I've highlighted that in the previous video. And then you can see my income ETFs, which are HDIF, HYILD, and HDIV. Those are just pumping out passive income for me monthly. And yeah, and so for monthly dividends, I got to $461 for the month of September, which was good. I think my next quarterly dividend might be a little bit lower than the last quarterly dividend, just because there's been a little bit of a reduction in the distribution for VFE. Um, yeah, it's okay. It's all good. So yeah, and I actually layered in as well the distribution for VEQT that I will get in January into this graph. So you can see here this annual yield. So I have my monthly, quarterly, and then annual because VEQT actually has a annual distribution frequency. So you can see that little bit of annual yield will be added there. So January will be a pretty huge month. It looks like probably over $750 in dividends. So that's gonna be exciting. Yeah, so that's about it. There's been a lot of volatility in the markets lately. Like I think it's like past month or so, it's like the markets are down like over 6%. So I think it's a great buying opportunity. Like if you compare this to what happened last year where we were down like over 20%, that this is nothing. It's just a great buying opportunity. Honestly, you could just buy your stocks at a lower price and get more shares for the same amount of money. So why not take advantage of that? So yeah, that's about it for this update, and I'll see you in the next one. Thank you for watching.